Good day everyone, my name is Chan Wei Sen, metric number 2628007. Now today I'm here to present our group presentation. So our topic is the foreign exchange. So we go to the next slide. Okay, foreign exchange market is what? Okay, this is a market in which the currency of different country trade against each other. So just like the trading of goods and service in an ordinary market. So in foreign exchange market, it is one currency money that in exchange for another country money. So after that, we go to the next slide. Okay, the foreign exchange market is the bigger financial market in the world every day. Transactions worth about $5.6 trillion are carried out within the market. So the major aim of introducing the foreign exchange market is to facilitate international trade by enable business to perform transactions outside their local currency. A foreign exchange transaction is an agreement between a buyer and a seller that a fixed amount of one currency will be delivered for some other currency at a specific date. Okay, so we go to the next slide. Okay, need of foreign exchange market. What is the need of exchange market? So of course it's money. Money is essential for the smooth running of every modern economy. Every government have a own authorized currency. However, the currency of a particular country is accepted only in the geography boundary of the particular country. So if you purchase web from USA, you are bound to make payment in USD. So if you use money in the Malaysia, it's a ringgit Malaysia. Singapore is a Singapore dollar. So we go to the next slide. Okay, the foreign exchange market provide the physical and institutional structure through within the money of one country is exchanged for that of another country. The next is the determination of rate of exchange between the currency and is where foreign exchange transactions are physically complete. So they got four characteristics of forex market. Foreign exchange market is almost a 24-hour market. So interbank traders are major player in the forex exchange market. So 90% of trading take place with respect to the US dollar. So they use the US dollar to exchange the market, exchange the money. So the region for quoting most exchange rates against a common currency is a vehicle currency. So we go to the next slide. So the next is the function of the foreign exchange market. The foreign exchange market is the mechanism by which participants transfer the purchasing power between the country, obtain or provide the credit for international trade transactions, and minimize the exposure to the risk of exchange rate change, the facility for hedging and speculation. So the last I will speak is importance of foreign exchange in international trade. They got three importance. The first one is a volatile exchange rate. So if an exchange rate is volatile, foreign investor cannot accurately predict their investment return. So even if they invest is holding that gives stable consistency return in a foreign currency, if the foreign currency is liable to that dramatically change its value, then the investment is similarly volatile. So the next one is a stable high value. So a high value currency encourages the import market while discouraging the export market. This is because foreign investors can increase their return on investment (ROI) by making the money in the currency that go far in their country. Export, however, are harmed as they are not worth as much overseas as they are at home. So the next is the stable and low value. A currency that have low value encourage the export and discourage the import. This is because goods sold overseas for higher value currency and worth even more than their face value so because of the currency value. Conversely, there is like incentive for importer to bring good into a country, and if they do, importer must mark this good into a it must mark the good up in order to recover their losses due to the low currency. That's all my part. I will pass to the next presenter. Thank you.
Hi, my name is Goh Ming Long. Metric number is 2C3264. Today, I would like to discuss the effect of foreign exchange rate on export and import. The first effect of foreign exchange rate on import is it will cause the change in the price of imported goods and services. This has a direct effect on the consumer price index. And appreciation of the exchange rate usually reduce the price of imported consumer goods and durable raw material and capital goods. For example, when the value of ringgit is weaker than another currency, price of goods and services from another country will become high to Malaysia importer. It means then needed more ringgit to purchase same amount of foreign currency to buy goods and service. It also means then Malaysia importer will reduce the purchasing power. When value of Malaysia is higher than foreign currency, the price of imported goods will become cheaper. This will allow Malaysians to buy foreign cars that used to be expensive. The effect of foreign exchange rate on export is it will change in the growth of exporter. A higher exchange rate made it harder to sell overseas because of a rise in relative price. If exports slow down, the exporter may choose to cut their price, reduce output, or cut back employment level. For an example, in a strong ringgit situation, this means it takes more foreign currency to buy ringgit. Good and product or exporter Malaysia become expensive for foreign consumer and resulting in them buying fewer Malaysia product. This will cause some exporter will face lost profits and economy of exporter country will become weak. It happening in a long period. It is the opposite situation to the foreigner when the value of ringgit is lower than other currency. The higher the value of the country currency, the more expensive it is for foreigner to buy export from that country. Similarly, the cheaper it is for people in that country to buy imports from other country. So I conclude then higher exchange rate will decrease export and increase import in that country. I will continue my presentation by discussing the way to mitigate foreign exchange risk in international trade. There are three ways to mitigate foreign exchange risk. The first way to mitigate the foreign exchange risk is using hedging strategy. Hedging strategy can protect a foreign investment from currency risk for when the funds are covered back into the investor home currency. Hedging currency risk can be used with exchange traded funds. There are many exchange traded funds that focus on providing long and short exposure to many currencies. The second way to mitigate the foreign exchange risk is using forward contract. A forward contract is an agreement between two parties to buy or sell a foreign exchange rate at a present exchange rate and predetermine future date. Forward contract can be customized by amount and date as long as the settlement date is a working business day in both countries. Forward contract can be used for hedging purpose and enable an investor to lock in a specific currency exchange rate. This contract requires a deposit amount with currency broker. Although forward contract provide a rate lock to protect the investor from adverse moves in an exchange rate, that protection comes at a cost since forward contracts do not allow investors to benefit from a favorable exchange rate move. The third way to mitigate the foreign exchange risk is using foreign exchange option or currency option. It gives the investor the right but not the obligation to buy or sell a currency at a specific rate on or before a specific date. Unlike forward contract, currency options do not force the investor to engage in the transaction when the contract expiration date arrive. However, there is a call for that flexibility in the form of an upfront fee called as a premium. The investor need to make a good initial investment in which it earns a gain when buying an option to have an overseas investment. Thank you.
My name is Wong Chen Yang. My matrix number is 261947, and today I will make an introduction to foreign exchange forward contract and foreign exchange option. So what is a forward exchange forward contract? It is a firm and binding contract between a customer and a bank for the purchase or sales of a specific quantity of a stated foreign currency at a rate of exchange fixed at the time of making the contract, and for performance by delivery and payment at the future time agreed upon when making the contract. So there are three types of forward contracts, namely fixed date forward contract, single option, and multiple option forward contracts. So fixed date, we have known, they have a fixed date to deliver the currency. While single options, you have single period of, you can choose whenever date in the period to deliver the currency. While the multiple options, that you will have multiple periods of dates to deliver your currency. So why we are using foreign exchange forward contracts? So the purpose of an FX forward is to lock in an exchange rate between two currency at a future rate to minimize the currency risk. So that might be done, for instance, if a company is contractually obliged to pay a set of amount for the future delivery of goods in foreign currency and wish to lock in the rate. So now, let me explain how does FX forward contracts works. So let us assume that the spot rate is $1 US to €1. So a business in US, which is a seller, they plan to sell a 2 million euro worth of products to a European company and receive the revenue in 12 months. While the US business is concerned that the dollar may strengthen against the euro and reduce the value of its exports. Therefore, it enters into a FX forward to sell the 2 million in 12 months to lock in the rate at $1 to 90 cents of euro. So this is one of the way to protect its income. And at this time, at this moment, if the rate is $1 to 90 cents of euro, the profit, the revenue that the seller will get will be 1.8 million US dollar. So let's say after a year, if the spot rate is $1 to 1.1 euro, then the seller will be profits. They will have benefits from this because the revenue will raise to 2.2 million. However, if things go another way, if the spot rate at the time is $1 US to 80 cents of euro, which is the currency of the US has rise against the euro, then the seller will get only 1.6 million of revenue, which they suffer some loss. So this is how the FX forward contracts work. So next, let me explain what are the foreign exchange options. Well, forex exchange options are also known as forex options or currency options. Well, they are derivative financial instruments, or in particularly forex derivatives. Well, in foreign exchange options, there are two types, which is FX call options and FX put options. Well, the purchaser of an FX call option has the right to buy the underlying currency. The seller of the call option has an obligation to sell the underlying currency if the purchaser exercises his right. and FX put options give the purchaser the right to sell the underlying currency, or the seller of the put option must sell the underlying currency if the purchaser exercise his right. So in all FX transactions, one purchase a currency for another one. Therefore, every single currencies are paired and trades both as a call and put. So why we are using FX options? The FX option market is the options market with the highest depth and liquidity in the world, while market participants can use different strategies for limiting risk and increasing their profits. So how does FX options work? So let's assume that there are a European Euro USD options that could give the holder the right to sell 1 million euro and buy 1.2 million of US dollar on December 1. So here the agreed strike price is euro against USD 1.2. So if on December 1, if the exchange rate is lower than 1.2, okay, so let me show an example here. If the exchange rate by that time is 1.15, then the holder will exercise the option. If the holder exercise the option, then we can calculate here 1.2. We'll use these calculations, and then the holder will get a profit of 50,000 of US dollar by exercising these options. So as you can see, we can eliminate the upside risk of Euro USD by paying the premium, and at the same time, the holder can still profit from a drop in the currency rate. So next is how to compute a forward rate. So in this equation, the forward rate is equal to the forward rate equation is using the spot rate of the currency pair, and RD is the domestic currency interest rate, RF is the foreign currency interest rate, and T will be the time of contract in days. So if in this type of situation where a US dollar and a Canadian dollars are traded at the spot rate of 1.3122, and the domestic currency interest rate is 0.75%, or the foreign one will be 0.25%, and the term of the forward contract is 90 days. So let us put all these numbers into the equation. So we'll get this. So after all the calculations, the forward rate that we have is 1.3188, and this is how the forward rates are calculated. Thank you.
Hi, my name is Dan Sherwin, entry number 261460. So I would like to continue our presentation, that is application of forward contract in international trade. So this is a slide or the example of how a forward contract in international trade. ABC factory in Addis Ababa is looking to buy motorbike from Taiwan. The business meet with the supplier and agree to pay USD amount 500,000 in 3 months. The current GBP divided by USD exchange rate is 1 equal to 1.32. So ABC factory therefore expect to pay GBP amount 378,788 for the equipment. In 3 months' time, the GBP 1 equal to USD 1.25. So here is what could happen if ABC factory doesn't use the forward contract. In 3 months' time, when the business is ready to pay for the good from Taiwan, the exchange rate has moved adversely for ABC factory. That's it. GBP 1 equal to USD 1.25. This means that the good will cost 400,000. So ABC factory will pay 21,212. It means it is more than the anticipated originally. The scenario 2 is the ABC factory use the forward contract. After 3 months, ABC factory will negotiate a forward contract with a currency provider. The result is that ABC Factory will set 21,200 until by thinking ahead and protecting itself with a forward currency contract. So this is the application of forward contract. Okay. Next, I would like to explain the type of conventions FX transaction. The first FX transaction is mail transfers. Mail transfers, they are sometimes refers to a mail payment order. For application or mail transfers, the customer must give written instruction to his banks for the issues of such foreign exchange transaction. The transaction must state in details the beneficiary name and address, telephone number, and the name of his banker it knows. So it usually stated the method of payments, which may be by cash, by check, or by debiting his account. The second FX transaction is banker draft. Banker draft is a check usually issued in foreign currency. The procedure for the application or draft is similar to that of mail transfers. The main difference between them is that the customer had to send the draft to the beneficiary himself. The banker drafts are not so popular payment if compared to mail transfers or telegraphic transfers. So the next I would like to explain the telegraphic transfers. It is a transfers payment order to named beneficiary by West or Delhi or cable through banking channel. The application for telegraphic transfers must clearly state not only the beneficiary name and address, but also the beneficiary account details with the foreign banks. Payment by telegraphic transfers is faster than mail transfers and draft, but the charges are a bit higher. If the amount transfers is large, the cost saving in interchange become appreciable and should not be overlooked. The last of all FX transaction is Swiss, or we can call it long-term Society for Worldwide Interbank Financial Transaction. This is a transaction, a cooperative society created under the Belgian law and registered in Brussels. The society is owned by banks and other financial transactions. The objective for the establishment of Swiss are to enable members to transmit between themselves on payment transaction, statement, and other methods related to international banking. This money transfer system is commonly used by banks and other financial institutions worldwide. So that's all for me. Thank you.
My name is Wong Chong Ning, number matrix 261339. For a conclusion, as we have mentioned that the foreign exchange is a market in which the currencies of different countries are traded against each other, just like the trading of goods and services in an ordinary market. While the foreign exchange market is one country's money that in exchange for another country monies. While for the needs of foreign exchange market is the money. Money is an essential for the smooth running of every modern economy. So every government have its own authorized currency. Furthermore, for the foreign exchange market has provided the physical structure determination of rate of exchange between the currencies and the foreign exchange transaction. While the characteristic of it are 24-hour trading hours and interbank traded. Its function are transferring the purchasing power between the country and the facilitating for hedging and speculation, and also minimize the exposure to the risk of exchange rate changes. Moreover, volatile exchange rate stable with high value and stable with low value. In addition, effect of foreign exchange rate has included changes in the prices of imported goods and growth of exports. Through the few methods of hedging the currency rate, forward contract and option contract has been used to mitigate the risk in the international trade. Mail transfers, bankers draft, and telegraphic transfer are also referred to the type of commercial foreign exchange transaction. The reason of using the foreign exchange forward contract and foreign exchange option is to minimize the currency risk and highest debt and liquidity respectively. As for the Malaysian perspective on the foreign exchange market, like any country, foreign exchange can be traded in Malaysia as long as it is traded with a legal financial institution. There are several legal and another word approved institution that trader can use as a medium to trade foreign exchange. The simplest way to trade the foreign exchange in Malaysia is by using one of the few approved institutions or also by maintaining the Islamic account. Islamic account is an account that comply with the Islamic or Sharia law is offered to both Muslim and non-Muslim. Another point is that overseas investment is considered as foreign investment in Malaysia. There are also a less probability that people will get caught for trading foreign exchange in Malaysia due to the law applied in the country that will complement the needs of ruling governments, which is in favor for the government to take action if needed to and reserve to have control on what is happening in the market. Nonetheless, authorities won't be coming for anyone as long as the people who traded do their trading lawfully, unless there is a law that has broken the law by the trader. That's all from us. Thank you.